Welcome. My name is Julina Ogilvie, partner and wealth advisor here at Principal Wealth, and this is the final webinar of 2024 titled Holiday Cheer. And as always, I'm joined by our founder and CEO, Bob Paolucci. Bob, welcome.
Good morning, Julina. We made it.
We made it, the
Mm.
last final event of the year. There's a lot that has transpired over the year. As you and I have talked about, we are in the second year of a bull market. We're very aware that we came through an election year. And so all of this uncertainty is going to create opportunity going forward. And we want to try and address some of that today, if that's fair.
Yeah, we'll certainly illustrate some of the opportunity that has played out this year already. We'll hint at some stuff for next year, keeping in mind that in January, so our very next market video is going to be our outlook that we do in January, which will be a little longer, more detailed. We'll cover a lot more,
Mhm.
but we'll get right into this one.
Great. So as we have been following the cadence, we're going to continue to address in three key areas: the markets, the economy and policy, and everything else is our last bucket. Bob, anything on this agenda that you want to quickly go through before we get started?
No, we'll talk about forecasts, big Wall Street firm forecasts, and how they are created and how they are, directionally off all the time. We'll illustrate the bull market. We'll get into some of the seasonal trends. We'll remind everyone about cash levels. We will talk about the bond market a little bit, how it's on sale and why. We'll cover sort of our view, at least in the short term, of what inflation looks like and will look like, and how that ties to interest rates. We'll bring up some softening points as it relates to the impact of monetary policy, more so mortgages. We'll talk about sentiment, and we'll get into everything else at the end.
Great. Well, I guess let's get started. And
Let's do it.
I'm a big fan of this first title in regards to Wall Street's estimates titled Cracked Crystal Ball.
Yeah, so the forecasting is wild, right? So all these firms, it's all media driven, it's all headline driven, it's all, advertising, right? It's
Mhm.
it's putting a number out there because you have to, not because you want to. And these big firms every single year, usually November, December, they come up with their forecast looking forward in the new year, what the market will end at by the end of the year, right?
Mhm.
What people forget is how many times they revised their forecast during the year based on things changing, right?
I think we
And,
lost count this year.
and the amount of change in their forecast, it's wild. I think Goldman Sachs had said, throughout the year, we were going into a recession, we're in a recession, we're not in a recession, we're not even close to a recession, we might be in a recession, we're not in a recession. And that was just the calendar year 2024.
Yes.
So never mind 2023. That was even more bizarre. But just to give you an example of how things change. So here you have most of the big Wall Street firms, their forecast at the end of 2023, looking into the year or for the year 2024, you had the price level of the S&P that ranged from 4,200.
Hmm.
That's where, we would be right about now, all the way to 5,400 on the high. We might as well throw our hat in here. Ours was right around 54, 5,500. I'm happy to say that we were the closest to the actual target,
And we were, yeah,
um, to actually, where the market is.
yeah.
And, the average target being 48.61. Now, that's fine, but that's 24% away from actual,
Yes.
right? Now, we should also remind you this isn't unusual. This is very common, right?
Yes.
The market, the S&P 500, rarely returns between 8 and 12%. Rarely returns between 8 and 12%.
Very
It will
rarely.
it will average
Mhm.
over a long period of time, 5, 10, 15, 20 years, somewhere between 8 and 10%, depending on the
The
when you're
timeline.
measuring,
Yeah.
depending on the increments of time, but it'll never actually make the number. The Wall Street firms use a very simple formula. What are the expected earnings through their lens of the S&P 500 times what they think is a reasonable multiple? And the multiple is the PE ratio, right? So you simply take earnings. So let's say earnings on the S&P are expected to be $300 per share, and you multiply it times the multiple. Let's say the current multiple 23. You end up with a price target of 6,900. It's as easy as that. That's how it works, right?
Absolutely.
And and then you look at it and say, well, wait a second, that's about a 10-12% return from where we are. Yeah, that's about right. Is that what the market does? No, it usually is way above
Yes.
or a little below. That's it.
But yet Wall Street always ends there.
So when you hear this ridiculous forecasting game, it is simply driven by guessing what earnings are going to be,
Mhm.
multiplying it times a fair multiple or their view of a fair multiple on the market, and then you get your target.
Yeah.
And shockingly, it's always way off,
Yes.
way off. So here you go. The average price target, the average guess by the big professional firms that do this for a living, of course, were off by on average 24%. We'll stay on this topic and we'll have more fun looking at their now estimates looking forward. So these are the
Next
ones
year.
that are out with published price targets so far. There'll be more in the coming weeks.
Mhm.
And what you see here, again, just like we said, is about a 10% increase,
Yes.
right? It's comical.
Yeah.
It's always between let's just call it a 7 and 10% increase. And here we are at a 10% increase. Will
Yeah.
it happen? We'll see. If we were to guess, we would be on the high side of this.
Mhm.
Again, mostly driven by the setup that we have in not only the economy,
Mhm.
but also the capital markets. Again, these things matter. Record levels of cash, great clean balance sheets of corporations in the United States, portions of the market where sentiment is low,
Mhm.
typically that
Yeah.
reverses course and provides some positive momentum. The fact that these companies are very profitable on the market nowadays, consumers are strong, there's a willingness to spend money, and it is certainly has been more of a pro-US business stance versus um, foreign economies and foreign markets, probably
Mhm.
for the past 8 to 10 years. In essence, it feels like companies and some policy in this country is starting to skew more towards the U.S. versus overseas, and I think that's good for U.S. based companies. So
Okay.
more to come on that, but you can see the game that is played again. We showed you last year. Now we're showing outlook for this year. We think it's comical. Again, if we're to put a number up there, we'll be on the high end here again, probably above 7,000 on the S&P. Current level, yeah, is right around what 6,100 or so. So
So we continue to be optimistic going into next year.
yep, we'll save a lot of that for next month and tell
Yeah.
you why. Optimistic. That doesn't mean the market won't be volatile, right? That doesn't mean
Absolutely.
there won't be negative months and negative quarters. Just
Mhm.
when you measure at the end, when it's all said and done, it should be, based on the setup of another pretty good year.
Yeah, that's great.
Yep.
And I think to continue along with equities, we've talked for the last 2 years about how there has been market leadership within the S&P, and that has continued if you want to kind of go through this.
Yeah. So interesting chart, Lena, right? We were looking at this. It's skewed because it starts at the bottom of the bear market or the beginning of the bull market just over 2 years ago.
Correct.
And the market, let's just focus now on the gray middle line. The market's up about 60%, probably a little bit more now, 65% since the bottom, the actual measured in a whole bottom, to
Hmm.
just about a week ago.
Yeah.
And you then look within the S&P, which are the lines above and below it. So below it are 493 companies that aren't the Magnificent Seven.
Hmm.
They are up about 35%. So they've trailed the market since the bottom, right?
Yes.
So then how did the S&P somehow get to a plus
Okay.
57
Yeah.
while 493 companies only got them plus 35? Well, the Magnificent Seven, the biggest weights, literally the biggest weights of the S&P, the biggest companies, Facebook, which is Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, accounted for a 148% lift,
Hmm.
right?
Yes.
So it more than offset the underperforming 493. That's how you get to your 57% on the S&P. So will that continue going forward? Probably not. I think the 493 and even below them, if you get out of the S&P 500, smaller and mid-sized companies
Yeah.
will actually start doing much better. They have done a lot better relative to large cap over the past quarter. So
Yes.
for those watching, small and mid cap companies have outperformed large cap companies over the past quarter. That's something we've been waiting for, something we've talked about early in the year, which is why we started adding some of that exposure for clients, and it's worked
Absolutely.
quite well. So what does that mean? That means if you have more participation from the non Magnificent Seven and everything below, even those, you have a broader, deeper market that is a healthier market. That's a very, very good thing.
Yeah.
So, yeah, could these seven companies continue to outperform? Yeah, they could. Will the outperformance on a relative scale be as much? Probably not. I think you're just going to see more participation. They may very well do quite well, but I think the rest of the market may do either as well, if not better.
Yeah. And we're going to touch on earnings in a second, but we did address last month in the webinar that the earnings outlook going forward is not going to be reliant solely on the Magnificent Seven. And
Yeah.
that's reason for optimism that this market will broaden in its return. So
Yep. That's right.
great. And I know a lot of our listeners are familiar with this phrase, the Santa rally. And I think this is a really interesting slide that addresses that.
Yeah. So December tends to be a pretty good month. The second half of November tends to be great as well. It's the first half that gets influenced by end of October activities. But long story short, looking back roughly over 100 years, the month of December was the worst month of the year only once in history.
It's amazing.
So, why? There are many reasons for it. So, I guess when you stare at this chart and you've listened to some of the things that we've talked about on these videos, the key rebalance fiscal year planning, calendar year planning events usually happen just before June. So, that's why you see May as historically not the best month. That is why you see August and September, for those of the fiscal year end 930,
Hmm.
you tend to have some gains and losses being booked, and those are booked by selling and rebalancing, right? And then a lot of the year end activity, rather than institutions and the people that work at institutions waiting for December, they tend to get it out of the way earlier in the last quarter, right? So therefore, there's October.
Yeah.
December tends to be time spent with family, wrapping up other things before year end, and not really institutions focusing on shorting the markets and
Hmm.
doing manipulative stuff. And it's more of a positive euphoria, positive vibe, lower volume. Right, the second half of December, there's no volume, and it tends to be more of a euphoric theme in the market, which is more net buying than selling,
Yes.
on top of the fact that a lot of that negative stuff has usually come out of the market by August, September, October.
Yeah.
So therefore you clear the runway, you clear the path for a pretty successful December. And even the first quarter of the year tends to be pretty good.
Pretty good. Yeah,
Yeah.
absolutely.
So is it a Santa rally, or is it, you know, other things throughout the year that pave the way for year-end success? You call it what you want, but this is how it sort of breaks down.
Right. That's
Yep.
great. And I know we were just touching on earnings, so we wanted to at least share what the estimates were for next year and going forward.
Yeah, so fundamentally, right, the market is rising because earnings are backing it.
Yes.
That's usually how it works. There was a period of time where that didn't work, and you have to go really to 1997, 1998, and 1999, where the market was rising, but on this chart was nothing. There
Hmm.
were no earnings,
Yes.
or
Yes.
significantly lower earnings relative to where the market was trading. That is not the case today. Earnings are breaking records. And because of that, markets are breaking records, right? Earnings are at an all-time high. Markets are at an all-time high. And that's the way it should be.
Yes.
If markets are at an all-time high and earnings are not, what do they say? Run for the hills.
There's dislocation. Yeah.
Yes, right. And for those listening, we pay close attention to this. If the
Yeah.
market all of a sudden has lower earnings or no earnings, your portfolio gets rebalanced immediately. Don't you worry. If that's not the case, companies are making a lot of money. People are spending money. Institutions are spending money.
Mhm.
And the net credit position, business balance sheets are great. The benefits of 15 years of near zero interest rates are continuing to shine
Yes.
and allow these capital markets, businesses, consumers, so on and so forth, to continue to thrive. And that should be the case for some time. So earnings are up, therefore markets are up, therefore price outlooks are up, and therefore euphoria is up. So, don't be down in the dumps. We don't see earnings turning around or turning negative or turning flat anytime soon. You
Mhm.
just have to be willing to look forward.
Correct.
You got to look out a year. Companies are going to have, an occasional miss on a quarter, an occasional two consecutive quarter miss. Rarely will you see three quarters. And usually, if it's ever four, then
Mhm.
the entire business model, C-suite changes and they bring people in that can make a difference. So,
And we should probably also point out that these numbers are from Morgan Stanley, which is one of the firms that tends to be on the more conservative side.
yeah. Yeah.
And so this is more maybe a moderate baseline, if that's
Yeah,
fair.
we had to put something up, so we picked one from Morgan Stanley, and even then it just shows a incremental increase in
Exactly.
earnings
Exactly.
expectations,
Yeah. No,
looking out a
thank
couple
you.
of years.
And we were just talking about how the S&P has returned 57% over the last couple of years, and yet we still have records amount of cash.
Yeah, well, that is what we always say, right?
Exactly.
When large sums of cash are on the sidelines, usually at the worst possible time,
Hmm.
and like clockwork, that has happened yet again.
Exactly.
Instead of showing you the slides that we've been showing you over the past couple of quarters, where the absolute level of cash is, $8 trillion, it's still there.
Yep.
Um, we decided to show you this one, which is the flow into government money markets.
Correct.
You would think by now, seeing that money market rates and the Fed has been cutting rates, they're starting to decline.
Correct.
We're in a bull market. Cash might be the worst performing asset class this year, again, like it was last year.
Hmm.
And don't get me wrong, in absolute terms, it's still okay. But relative to just about everything else in the capital market structure, it will be the worst returner.
Hmm.
Of course, that's the case because there's this delayed reaction. The bear market was in 2022. A ton of money came out of the capital markets, went into cash like it always does, and it
Yeah.
usually stays there for a long time. For a long time. It
Exactly.
usually stays there while the bull market does its bull market thing and sends the market up somewhere between 150 and 250% for the period of a bull market.
Yeah.
And only near the end do cash
Investors look in the
balances
rear
start to
view
decline.
mirror.
Yeah, because it's almost like, hey, all right, 6 years of good market returns. I'm finally ready to get off the horse that is
Yes.
cash and start investing again.
Yes.
And, that's probably the worst time to do it. But unfortunately, the trend is this cash levels are high at the highest level ever. We're 2 years into a bull market,
Correct.
which, is unfortunate for those in cash. And then the flow into cash continues, even as rates, you can see in the top right hand side of this chart, even as rates are declining.
Have begun to decline. Yes. And on top of the opportunity and equities that we've been talking about, we should also share with our listeners the opportunity that we see in the bond market.
Yeah, cute title, Cyber Monday, bonds are on sale. Yes, they are. For a very specific reason. So historically, you look at about a 10-year period on the left-hand side, the decade ending, rolling decade ending 2023, so 10 years prior. Average price per bond was a little over par, 101, right? 1% over par, par value being 100. Um, as of September 30th of this year, the average bond price is $94. So, a bit of a discount, actually a pretty good discount.
One we haven't seen in a long time.
Yeah, yeah. And in the world of bonds, that's a pretty substantial discount.
Yeah.
On the right hand side, percent of the U.S. bond market trading at a discount. So under par, 63% of bonds trade under par. What is interesting is 24% of them trade under 90, so greater than a 10% discount. So huge discounts. Now, typically when you see something like this, if you look back historically and you see a chart like this, you say, "Whoa, boy, what's going on? They're at a discount for a reason. The bond market is smart. That's the smart money. They know something we don't know." No, what it is for the 15-year period where we had rates near zero or at zero, many municipalities, many corporations issued debt, issued bonds at record low levels,
Hmm.
right? At levels that they never thought they would ever see. So what they did at the time is think about it as us refinancing our debt, right? If we had a 20% credit card and we got a 0% offer, well, we're going to take the 0% offer and pay off that high rate credit card.
Right.
So all companies, in many cases, people, in some cases, municipalities, either refinance their debt, their higher yielding debt with lower yielding debt, lower yielding bonds, and or they just issued bonds even when they didn't need the money, right? It's just we make 20% on each dollar. Why don't we just borrow at 2%
Yeah.
and make levered dollars? And many companies did this. The
Hmm.
reason why these bonds trade at a discount is because the bulk of them that are being measured here in the secondary market were issued in a low rate environment. Now we have a much more normal rate environment. And in order to get today's equivalent yields, those bonds have to be discounted down, discounted down.
Hmm.
So is this important? It is from a safety standpoint. The bulk of the bond market probably won't see a price decline
Hmm.
unless there is a wild spike in interest rates
Correct.
from here because they're already at a discount.
Yeah.
So, there's some security and insulation, generally speaking, at the aggregate level of the bond market, seeing that prices are already at a discount, they'll very likely just creep up as they get closer to par.
Hmm.
That makes sense?
It does, and I think for maybe some of those listening that aren't as familiar to how the bond market works, the opportunity with the discount, to your point just now, is as it appreciates back to par, there is a price appreciation on top of the income that you're getting on the bond.
That's right.
Exactly. Okay.
Yeah.
Thank you.
Yep.
And this all happens while investors choose to sit in cash. So
Exactly.
let's transition to another area of the bond market that we like, which is municipal bonds.
Yeah, we don't often talk so much about bonds, nor do we talk much about municipals. But this one is a very interesting chart. The health of municipalities is municipalities and states are in great shape, right? Typically, this chart doesn't look like this. There's a lot more red on the chart.
Uh-huh.
And what you have here is the inflow of stimulus money over the past handful of years. You have rising property tax rates, more importantly, rising assets, right? So if you have a mill rate, it's being applied to something, whether it be if you're in Connecticut, everything that you own, if you're in Florida, only a few things, like things you buy. But ultimately, property tax on your home, your car, if you're a business, the things that are inside of your business,
Hmm.
hardware, so on and so forth. So mill rates keep creeping up and asset values keep creeping up. And what you have right there is a double whammy of inflow into states, generally speaking,
Hmm.
on top of the fact that incomes are up over time. So therefore, income tax rates at the state level, which rarely go down,
Hmm.
even if they just stay flat, they are collecting more tax receipts,
Correct.
right? So the health of these municipalities is quite good, and the credit quality of these states and municipalities is also quite good, with many of the you know medium credit municipalities just over the past few years being upgraded.
Yeah.
So there's certainly safety and opportunity here, and where the yield curve is, which we'll talk about probably next month. Municipals look very attractive. You're actually getting higher quality and pretty good yields relative to corporates and treasuries.
Yes.
So
And I mentioned to you earlier, I can't recall in my career the last time this looked as attractive
we
from
were
this
saying that
perspective.
before. Yeah, we you typically never see this.
No, not at
Yeah.
all.
So
So,
and things
um,
can change quickly, but
they
as it stands, this is what it
fair.
looks like. Yeah.
Well, let's shift and focus on the economy and policy and start with inflation.
Yeah, so the path to lower inflation, again, it's already low. It's in the twos. What we're showing here is, remember, the inflation rate creeps forward and rolls higher or lower based on the new number that it acquires, right? So every month
Every month the number jumps off.
it acquires a new number and
Yep,
drops off a number from the back.
correct.
And it is about to have some numbers in the first and second quarter of the year that are going to be replaced likely with lower numbers. So these high numbers on this chart are very likely going to be replaced with lower numbers, which is going to very likely send inflation even lower.
Hmm.
Now, what hasn't really showed up consistently in the, let's say, past quarter's inflation number is a much weaker housing number. That's because there's a greater than a year delay when it comes to the shelter reading.
Correct.
Just like there was a delay on the way up, there's a delay on the way down. So this inflation number is very likely illustrating something that is artificially hotter and higher than where it actually is,
Okay.
right?
Hmm.
So the Fed, who goes off of the data, is very likely going to have a data point that is not sinking, but continuing to arc lower.
Correct.
Um, and I'm sure they know this because they stopped focusing so much on inflation and they're focusing more on employment.
Correct. Over the
Because
last few months?
yeah, the last few months, because they
Yeah.
know that this number is just going to continue to roll lower.
Yeah.
And they want to detach themselves from this data point that they were married to because this number may hit the ones. And if it hits the ones, then what are they going to do? Just cut rates down below 2%?
Right.
They don't want to do that. And
No.
admittedly, they don't have to do that. I think they end up somewhere around 3% when it's all said and done, assuming there's no emergency in the future.
Hmm.
And if that's the case, there's only about, 4 or 5 more interest rate cuts coming, about a point to a point and a quarter coming. We're talking, it is Friday the 6th. The Fed meets next week. I believe
Hmm.
they're going to do a quarter cut. So there's one of them. We think 4 more after that. We
Okay.
think the 4 will be played out, though, quarterly,
Exactly.
calendar quarters.
Yep. Slow and methodical.
Not every meeting like we've been used to now.
Mhm.
It'll be every quarter.
And staying on this topic, we should probably share with everyone how the interest rate projection has shifted.
Yeah, by a lot, pretty much every quarter. So this is the market pricing in interest rates, and you could see it's all over the place. With the most recent reading being, by mid 25, so mid next year,
Mhm.
rates, the overnight rates being somewhere around 375. So what does that mean? That means 75 basis points between now and summer. Yeah, that's probably directionally right.
Mhm.
It's getting more accurate now that the Fed is in action mode.
Correct.
That is the red line. But you can see how wild the projections have been from the
Yeah.
market. Now it seems to be directionally accurate.
Yeah, the most recent, which is the red line, isn't as aggressive of a decline as it was at the end of 2023.
That's right.
Yeah,
But it does get much lower than the blue line from October of 2023.
it does.
Yeah.
Absolutely. Yeah.
Yeah.
And we should talk about monetary policy because this is coming up a lot now.
Yeah, so look, it's not all roses, and here's one of the thorny elements that I think the Fed is aware of, and maybe why they are cutting rates.
Hmm.
And this chart, yeah, it's very important. So the lagging effects of monetary policy, right? So when you change something, or when you move from one extreme to another, something is going to be impacted, and it takes
Hmm.
time for it to show itself. And one thing that we've been talking about is mortgages, right? So this chart illustrates, you go up to about 2022, a large percent of outstanding mortgages had a rate of less than 3%.
Hmm.
And, in 23, it was almost the same. But you've seen a trend since mid 23 into, let's call it today, that fewer and fewer and fewer and fewer and fewer people still have that 3% mortgage. Why? Well, a few things. They either refied out because they needed money,
Hmm.
they paid off the mortgage, or they sold and moved elsewhere.
Correct.
So, when you think about the economy and consumer strength over a long period of time at low rates, when the cost of interest is low, it allows you to spend more money if you want to, or save more money, right?
Mhm.
When the cost of interest is high for the same thing, mind you, you have to cut back on something, right? Starbucks may sell fewer $11 small coffees.
Hmm.
If someone just went from a 3% mortgage to a 6% mortgage. And when you talk about inflation, interest cost is not part of it. So when you talk about real human experienced inflation,
Hmm.
right,
Yes.
this is one of those hidden elements. When you buy a car at 8 or 9% interest rates when you finance it, or you buy a house, and it's certainly relative. If you're getting out of a car loan where you paid 2 or 3%, you're getting into one that's 9 or 10% for the same car, your monthly payment increases pretty substantially. That doesn't show up in the inflation
No,
data.
no.
It shows up in the strength of a consumer, and it shows up in, are they consuming the same amount of goods and services?
Hmm.
So generally speaking, higher interest cost gets in the way of other consumption, and it puts a little bit more financial stress on those, who are in this new high mortgage rate zone.
Yeah.
So something to be mindful of. It also impacts the state of the housing market, residential housing market, because you can't sell as many homes to as many people in
Yeah.
a 3% environment than you can a 7 or 8% environment.
Right.
That's why there are no listings. There are a lot of people who, number one, can't afford the house that they were looking at 2 years ago, now with a new high interest rate. Number one. Number two, people that have a 3% mortgage who want to move are just waiting because, they need to buy another place,
They know
and
they're giving up that 3%.
they're going to have to give up that mortgage. So they're actually going to pay more, potentially even as they downsize.
Correct.
So, what we think, and we'll get again more into this in January, we think there will be some type of targeted policy when it comes to capping credit card interest rates, capping car loans, and maybe even capping and extending credit on the mortgage side. That would allow the Fed to maybe focus more on other things with their rate policy. There
Hmm.
might be some special program, we think, that comes out for home ownership for all. But more to come on that.
Yeah. Interesting. And we've talked about small business sentiment earlier in the year, but it's interesting to see some of the shift in the survey.
Yeah, this is the soft stuff, the mood of the room. So, generally speaking, the capital markets, investing, consumption, the holiday season, it's all better when everyone's in a good mood.
Hmm.
And right now, small businesses are quite depressed, coming out of an extremely low sentiment period. But it is now, at least in a short period of time, rising.
Yeah.
We think that this will continue to rise, mostly because it usually doesn't go much lower.
Yeah.
Uh,
We hit lows.
Yeah. And what that will do is there's some euphoria for small businesses, for mid and small businesses that creep up to even small publicly traded businesses. This is a very good thing. Usually, this is somewhat tied to regulation as well, and
And
that
possibly interest rates.
and certainly interest rates and certainly input cost and inflation.
Yeah.
So the trend is up for small business optimism. That also helps the bull market quite a bit.
Yes. And let's transition to our everything else section of the agenda. We have to start with tariffs. This is front and center on a lot of people's minds.
Yeah, I think depending on the TV shows you watch and the newspapers that you read, you may have different takes on this. So, we've all heard that Trump version 2 is going to focus heavily on tariffs, and he's going to swing the axe that is the US consumer as leverage against the rest of the world to renegotiate, old deals and so on and so forth. And I think if you listen to a lot of the very left-leaning economists, their view is this is going to create a massive spike in inflation. Well, it didn't last time. I think if you listen to a lot of the right leaning economists, there'll be no impact. Uh,
Mhm.
The truth is somewhere in between, right?
Right.
Our view is yes, it's a major negotiating tool. This is Trump's style. This is what he does. This is how he does it. This is how he did it last time. I think
Mhm.
just a lot of people forgot. And what we really, in this chart, focus on the period of time where he did it, 2018 to 2020.
Hmm.
It wasn't an inflationary outcome, it was a deflationary outcome.
Which is so interesting.
Yeah.
Yeah.
Yeah. The fear, of course, is look, we stop getting goods and or services from the rest of the world, and we
Mhm.
have to replace it with more expensive goods and services. Well, yeah, that's not how it works. The rest of the world needs us, right? We're an enormous consumer that's impossible to replace,
Yeah.
and we're an enormous buyer of everything. And there are other benefits on top of that. And you don't want to lose our business, right? We are an enormous client,
Yeah.
and we have to be taken care of. And Trump knows that, and he's gonna use it as leverage in
Yeah.
trying to renegotiate many things. Now, through the renegotiation process, will we be net positive or negative? I think we might be net neutral when
Yeah.
it's all said and done, right?
Okay.
We may
Yeah.
pay less for a few things, pay we may pay less for some things, more for some things, a lot more for some things, a lot less for some things. And when you net it out,
Yeah.
I think it's going to be just like it was last time, probably net neutral. So I wouldn't worry at all about
Mhm.
this. It will all net itself out over time. And I wouldn't overanalyze or worry so much if one data point comes out. You have to measure it in aggregate. And I think to do that, you have to measure it over a period of time. And I
Mhm.
think when we do, it'll probably be close to a net neutral scenario.
Right. Yeah, the media will pick at
Of
the
course.
higher ones and
Well, they're selling
filter it out.
advertising. Yeah, so
So,
they'll tell you everything you either really want to hear or more specifically what you really don't want to hear.
mhm.
So you get glued to the television or you
Yeah.
read the magazine, you read the article, you read, you know, the
Yeah.
newspaper, whatever it is.
No, that's great.
Yeah.
Thank you. And our final point for this webinar this month is the Department of Government Efficiency.
Yeah. So, very interesting. The Department of Government Efficiency, this new entity within government,
Hmm.
is looking to make things efficient. And they're already highlighting how we waste money in the country and, a bunch of other things. One thing that I think they'll be focused in on that does impact policy, specifically monetary policy,
Hmm.
ironically, is employment. And if you look at the bloat in employment of government, we now employ more government and government related workers than ever in history. It has taken up, it's been about 65.5% of the job growth in this country over the past 12 months, government and related, and it dwarfs all other sectors. So if there's mass layoffs or some other changes where the hiring stops and or firings or layoffs begin, that actually, because the percent of all hiring and the percent of all jobs is so high,
Hmm.
that is really going to impact the overall employment number. Now, the employment level, there's a reason why this is on here. The employment level is something that the Fed is focused on, and it's one of the key elements that the National Bureau of Economic Researchers views in their recessionary calculation,
Right.
right?
Hmm.
So you could have a scenario, potentially for political reasons, where there are a bunch of layoffs at the government level and a recession is called. Now, I don't think that'll happen, but I'm not going to say it's impossible. It will be the most fundamentally sound recession we'd ever been in if the one element that is flashing red is the new administration comes in and cuts a lot of jobs. If it's just that for a short period of time, that will be a bogus recession, just
That
so
would
you
be
know.
interesting. Yeah.
But it is not impossible because
Okay.
I think the Department of Government Efficiency will be focused on where there's excess employment in the
Hmm.
government and related system, and they will very likely do something about it, which will send the unemployment level up from wherever it is now, 4.142, depending on how you measure, probably up to closer to 5%. Now, look, 4 to 5% is still full employment, generally speaking, but it isn't the 3.6% that we had a handful of years ago,
No.
right?
Hmm.
Um, So we shall see. We bring this up here because I think we're onto something, and we're probably going to see this play out over Q1 and Q2 of next year.
Okay.
So more to come on this one.
More to come. Okay. Well, I think that we've got only a few weeks left in the year and it's been an interesting ride. It's been a fairly straight ride. And so I know as we enter next year, as you mentioned, we're going to have a more detailed outlook for 2025. And Bob, I don't know if there's any other comments you want to make before year end.
Yeah, the market this year was filled with headlines, not with volatility,
Hmm.
right? And usually, the more extreme the headlines, the more extreme it plays out in the capital markets. That didn't happen. I think the market was smart enough to look through a lot of the extreme stuff that was being floated and said and things that were
Yes.
happening. They were just focused on the fundamentals. And I think the capital markets will continue to do that in the new year. However, a good year in the market, when you look at a month to month standpoint, the stock market is up, a good year on average, seven of the
Hmm.
12 months,
Hmm.
right? This year, it's very likely we end with probably a 10 positive month to 2 negative month ratio, which is, unusually good.
Yes.
I wouldn't expect that next year. I think there'll be a little bit more volatility.
Hmm.
I think there will be a little bit more inconsistency, but I think the end result is still going to be very good.
Yes.
Um, I say this because if it's been an extended period where clients haven't had or seen a down quarter or a down month, you get used to good news all the time.
All the time. Yeah.
Yeah. And generally, over a long period of time, it is good news all the time.
Hmm.
But when you measure in small doses, you have to be realistic and understand that a good month usually comes with a bad month, and then maybe two more good months, and then a bad month, and then two good
Yes.
months, so on and so forth. To have a consistent string like we've been delivering to clients, set the expectation. It'll be a little bit bumpier,
Yeah.
but it should be pretty good. So to set that expectation, that's number one. Number two, my parting shot here for everybody is enjoy the holidays, get closer to your friends and family again, throw politics aside. Life is too short. Focus on your health, focus on your mental health, focus on each other, do good deeds, be good Samaritans, and everything gets better. If we don't do that, everything gets worse, and we stay in the weird social dark cave that we're in right now as a society today. Let's be positive and get back to where we used to be in the decades ago.
Yeah.
It's needed by all. So
I think that that's a great way to end. We appreciate the insight, Bob, and yes, wishing everyone a very happy, healthy holiday season, and we look forward to seeing you in the new year with a fresh new outlook. And as always, if you have any questions, we're here, and please feel free to reach out to us.
absolutely happy holidays and happy New Year, everybody.